Kia ora koutou and welcome to Markets, Mystics and Mayhem, a weekly podcast with Kiwibank's economics team alongside the occasional special guest. We'll delve into the data, decipher policy decisions, monitor the markets and analyse the issues impacting the Kiwi economy. Let's get into it. Kia ora koutou and welcome to the 28th episode of Markets, Mystics and Mayhem. We're coming to you on the 28th of April. Yeah, we have to timestamp ourselves these days. There's so much going on. Well, actually, not a lot has happened in the last couple of weeks. There is a lot that hasn't happened, and things seem to have calmed down a little bit in markets, but we're just in limbo. We're just waiting, which is painful from our perspective, but it's also painful from the economy's perspective. So we're going to get stuck into what hasn't happened in the last couple of weeks, what we think is going to happen, and sort of tie that back to the economic outlook and inflation. So let's get stuck into it. Sabrina, kick us off. What has and hasn't happened?
Okay, well, it's funny because I think, we took last week off just to give sort of the tariff negotiations a bit of a breather, hopefully come back with a bit of action, a big spike of news maybe. But we came back today and not a lot has really happened. There have been a couple comments from Trump around trade talks with China. He's saying that trade negotiations have started, but then China's saying that they haven't. So who really knows what's happening there? But there have been a couple of extra comments from Trump saying, he does intend a bit of a tariff de-escalation with China, paring back from the 145% tariff rate that they've got right now to levels more about 50 to 65% sort of tariff range, which, I guess it is an improvement from 145, but it's still really material, and it's still, it's about that trade diversion that still kind of has an impact when it's at a level that high. It's not that 10%, which is just a revenue grab that is sort of diverting trade. So it definitely, is still problematic for the global outlook. And like I said, none of this is really set in stone yet. We don't have any official deals. So we are just kind of in this limbo at the moment.
Yeah, it's amazing how the market rallies or takes relief in a 50 to 60% tariff rather than 145% one. So yeah, we are in limbo and we are expecting deals to be done. But just the waiting hurts, right? We've heard of a number of companies just cancelling their orders out of China, and that's already having a material impact, I think, on growth, right?
And that's kind of the first things you are looking for in this time of uncertainty are those anecdotes of these companies, halting their production or their, stopping shipments out from China. What was the example you gave? Amazon?
Yeah, Amazon cancelled their orders almost immediately following Trump's Liberation Day, which, they're not a small company. And I imagine those orders would have been pretty large and significant for those Chinese manufacturers. So, on the US side, we're expecting a slowdown starting already. And on the Chinese side, the slowdown started already, and the longer these negotiations take, the more economic pain, right?
Yeah, and that's pretty major because, again, nothing is settled just yet. But that uncertainty alone is already stalling, any activity from these companies, which is going to have an impact on growth. And it's just, that waiting around to see how this all settles.
And I think, if we look back to our episode we did 2 weeks ago now, we were talking about our upside and our central scenario. And the difference between our upside and our central scenario, when it came down to it, it was all about the timing of, how quickly these deals are made. And so, the fact that we're still waiting, I think we're still really kind of on the cusp of, are we leaning towards the upside or the central? But the longer we wait, the more markets stay in this sort of uncertainty kind of environment, and the more damage to growth that comes out of it. And I mean, we've already seen the IMF last week. They released sort of a preview of their World Economic Outlook report. The full report comes out in May, but they gave us a bit of a preview on where their global growth forecast were heading. And no surprises, really. It was a downgrade globally and to most major economies.
The US especially got
The US
the
especially,
steepest
yeah.
decline, right?
Yeah. So the US, I'm just going to quickly look at the numbers because I've forgotten them. But the US was downgraded to growth over 2025 being 1.8%. And
well below trend.
And then in 2026, it's growth for about 1.7%, I believe. And then you've got China on the other sort of side of the coin or side of the trade war. Their growth has been revised down again about 0.6 of a percentage point and half a percentage point for 2025 and 2026.
To 4%.
To 4%.
Which officials target 5%.
Yeah.
So, that's material downgrade.
Yeah, definitely.
Yeah.
Which just means that there has to be more, I guess, intervention or support from the officials there to boost them to get to that 5% growth rate.
Absolutely. Absolutely. I mean, over my economic lifetime, China's always used the infrastructure and that sort of investment as the button to push. Now they're trying to do more on the consumer side, which, is a natural sort of transition, I think, for them. But it's hard, right? It's hard when your property market's being devastated and your economy's already in a pretty weak position to then be downgraded again in the midst of a trade war. The outlook's pretty soft for China, and outlook's now softer for the US. Two largest trading partners there downgraded, not good for us. And our third largest trading partner, the ones with that twang of an accent, Aussies, right? They'll also get hit directly by the slowdown in China and the United States. So, yeah.
So it's a double whammy for us.
It is. Yeah, direct and indirect.
And it's not just the IMF that are downgrading their forecasts, right? It's, I think I saw the World Trade Organization, they downgraded their global merchandise forecast for this year again.
You have to, don't you?
And it went from a growth of, I think, something close to 3% for this year down to a contraction of 0.2%, which is quite a big swing on a global stage. And again, that is done on a scenario basis. Obviously, the worse these tariffs are, the worse the outlook does become. But that already is their base case.
Yeah. And so I guess just to point out, we mentioned our upside versus our central, and being the timing. That our upside scenario was that potentially these trade negotiations take weeks to come through. Our central scenario is that it takes months, right? And then downside scenarios that it turns into something a lot more aggressive. I still feel like we're going through that central scenario. It is going to take months, not weeks.
I think so already, because they've already had some time to do these trade negotiations between the US and Japan being the test case, and that's kind of fizzled. Nothing's come out of that.
Yeah,
I
remember you mentioning that before Easter, basically.
Yeah.
But then I was looking for it and haven't seen anything. So there's nothing happening there.
It sounded like they were going to announce within days of this meeting some sort of deal between Japan and the US. And of all the nations, you'd expect them to have the easiest negotiation, or one of the easier negotiations, but haven't heard anything.
Yeah, same with I think US and India again. The trade negotiations there have fizzled as well. So it's not just the uncertainty as to what this all looks like, but it's also the confusion as to what's actually taking place, what is being discussed. Because it's not just tariffs on China going down from 145 to 50 to 65, but also there's other options potentially on the table, which just adds to the confusion.
Yeah.
Which is rocking markets.
Probably a little bit of game theory in here as well. Like, maybe there has been a deal done with Japan behind the scenes, but they don't want to announce to everyone else that that's what the deal is. Otherwise, that becomes a benchmark. And, you just don't know what's happening behind closed doors.
Yeah. Which is just making it very difficult to trade in this environment. Financial markets have been rocked, whipsaw or roller coaster, are the kind of the terms we're hearing.
Yeah.
Describing the situation.
I think rates markets are fine. Like we sort of came in this morning and the 2-year swap rate's pretty much where it was 2 weeks ago. So that pivotal interest rate in New Zealand hasn't really moved. It's at 3.08%, and that's bang in line You look at the market pricing for rate cuts here, it's going down to about 270. We're at 2.5, so we would argue you still be long, still expect rates to fall further, but we're not massively dislocated. I think the market's kind of fairly priced for what's happened.
It's a currency though that's
Yeah.
a bit of a shocker. I know, again, maybe before Easter, I shot a video with marketing to put out on social media about what's happening to the currency, and that was around the time where the Kiwi dollar was actually at around 50. Well, it only traded briefly at 54 cents, but it was around 55, quite low. And now, over last week we hit a high and breached into the 60-cent mark. So it's really crazy the round trip that the currency has had. I guess just really with US, I guess deleveraging, is that the right word?
Yeah, I think when you think of the Kiwi, everyone thinks of the Kiwi side, what's happening with New Zealand, whereas actually it's the dollar. So Kiwi versus the dollar. This time it's the dollar. There has been an anti-dollar sentiment out there. Does it deserve to be the world's reserve currency? I still don't know of any alternatives to those saying that. But is that the case? And are serious investors taking money out of the US and putting more into elsewhere? That seems to be the case.
Yeah. And I think that could be the case. It could just be an unwind of that big, run up in the greenback or in US Treasuries at the end of last year. So it's just a kind of a correction, because there was a crazy end to last year when when there was a new administration coming into the US and he was spouting pro-America growth and all that. So that really led the greenback to strengthen. But may just be this last move is more of a correction, maybe. Theories are floating around everywhere.
Yeah. I mean, people come out of the woodwork, right? I've been calling the end of the US dollar for the last 30 years. Right. So you've been wrong for 29. So I think that's interesting. And it'll be interesting to see how that plays out. There has been a lot of talk around the euro getting a lot of support. The euro is only receives about 20% of global FX flow, whereas the US is in the 60s. The euro is the next best option. Where do you go from there? This is the thing. The gold bugs come out and say gold's going to, 5,000, whatever.
Yeah.
Same sort of thing. You just can't diversify everything out of the dollar. So, market pricing is, I think, taking into account lower growth rates, lower inflation, particularly in Kiwi rates, and some of the higher frequency data that we can get our hands on is around shipping, right? So shipping rates and cargo, and it's all down, right? It's all down in the last couple of weeks. It was the reverse in the start of COVID. If you remember, shipping rates went up and was hard to get cargo. Now it's the opposite. So I think that is leading to a reduction in global inflation.
Yeah, I think this is what's most key for the Reserve Bank, is how will inflation play out in New Zealand, because that's their main thing. And I think for us, it's going to be a period of disinflation, potentially deflation from overseas because of that trade diversion, potentially at a discount. So you'll see, I think, some interesting swings in tradable or imported inflation. But for the Reserve Bank, their focus very much is on core inflation and domestic inflation, the things that they can kind of control. And from what we're looking at, it looks like it's still in that slowing kind of trend where core inflation is now below 3%, the lowest it's been since 2021. Domestic inflation, again, is a much slower moving beast, but again, it's moving in the right direction. So for the Reserve Bank's forecast in terms of the medium term, it's this global growth backdrop that's weakening, that does put a bit of downside to the medium term. So again, it's just another case for more accommodative interest rates.
Yeah, so reduced price pressure from offshore comes in, helps our inflation outlook. But we've also seen some interesting data in recent weeks on Kiwi rents, right? One of the largest drivers of that non-tradable domestic component. And there was news news articles over the last week of rents actually declining, landlords struggling to get tenants. That's interesting.
Yeah. I think it probably coincides with this big departure of people from New Zealand, with that net migration really cooling off. So yeah, rental inflation's fallen below 4%, again at a low for a long time.
Which is good because it's been a sort of sticky, stubborn point over the past year, and now we're starting to see some relief in that space.
It's funny, the media writes it up as bad both ways, right? If rent's increasing, that's bad for average New Zealanders. If rents are decreasing, that's bad for landlords. It's like, wait a minute. I think there's a housing shortage in this country, and the fact that rents are coming off is a good thing. Because I think that spike just clearly represented not only that sort of migration boom that we had, but the fact that there's a chronic shortage here.
Yeah, just demand and supply at play.
Yeah.
But are we going to build for the next boom? Hopefully. But if we look at the history, probably not.
Exactly. All right, well, that's it. I think we're done for another week, another episode. A lot going on. It's an exciting world out there, and it's really hard to get a proper handle on how things are going. But it looks like the impacts on global growth and New Zealand growth are clearly negative with all this happening offshore. That'll wash through into a softer inflation outlook. We have inflation falling below 2% on our forecasts. That means the Reserve Bank can cut below neutral in our opinion. So neutral's 3%. We're currently at 3.5%. We're predicting 100 basis points worth of cuts to 2.5%, and that's how we get there. Global shocks, local disinflation, which is nice, and a central bank that has to do more to get us into a higher space next year. What the hell's a higher space? More growth.
Got there in the end. Awesome. Well, like always, be sure to follow us along, like and subscribe, and we'll see you next week.
You've been tuned into This is Kiwi Economics, Markets, Mystics and Mayhem. We'll be back next week for more analysis and insights.
Any views or information shared in this podcast, while given in good faith, aren't necessarily the views of Kiwibank.